Hey, what's up, everybody? Today I'm going to show you how I would evaluate a company and how much it would be worth in the future. This all depends how far you want to go into the future. For example, do you want to go so far into the future that all the countries around the world are similar, like the European countries and the United States? Or you're just gonna go like 10 years where things haven't really been changing, it's still the same economically. But if you were to go, let's go with the first one, which is how much would a stock be worth if everybody was well off, like the first world countries. Why is this important? Because ultimately, what it comes down to is the evaluation of the company. Companies, the price of a company in terms of the share price is just the evaluation divided by shares of the company. So it's simple. It's just evaluation divided by shares. And that's going to give us the price per share. And when you look at Yahoo Finance or what's it called? Robinhood. You have something called market cap, and you also have something called float, or they don't really show it, but outstanding shares. All right, let's put the outstanding, and this is similar to this, where if you divide this by this, you get the price per share. But this happens and changes minute to minute because it's very straightforward. And then you can switch these around. You can find the price per share by market cap divided by outstanding shares, or you could find outstanding shares if you divide market cap by share price, or you could find market cap by multiplying outstanding shares by price per share. And that's always changing minute by minute in the stock market while people are buying and selling on their computers or in the stock exchange with the big corporate traders. They're buying and selling millions and millions of shares. So that's always a very volatile way of getting these three things. But what I want to not suggest or advise, but just share what I would do is basically we keep this the same, as this. So this is the same. The only thing that changes is our opinion of what the evaluation is. Market cap and evaluation are the same thing, but we're going to find a different way to evaluate this company. And then we'll apply the same thing as outstanding shares and price per share. The only thing we're going to have to discover ourselves is evaluation, because market cap based on Yahoo Finance, Robinhood, is based on these two. And the one that people really focus on the most is price per share, which is what people are buying and selling. Hey, is the price too low? Is the price too high? Is the technical analysis, is the chart pattern look like it's going to make the price go down because people are wanting to sell in that place? Or do people want to jack the price up like GameStop because, hey, it looks like it's breaking out of a resistance and we're going to see a squeeze? All this trading terminology. So this applies a lot to trading, but this applies more to like investing. And so for investing, in my opinion, I'm not a financial advisor. This is how I would discover my way of evaluation. Okay. So how do you discover evaluation to then conclude the price that the stock will be at its peak, at its best? So we're trying to find out the best evaluation possible in the best case scenario. So this is going to be oversimplified, but let's start with writing that down. Best case scenario. And then we got to think about a company, just to get an example of a company I think cars are probably a simple way to figure that out. Cars, because Tesla is one of the more popular stocks. A lot of people are gonna own electric cars in the future, and it kind of gives, even though it's not well established yet, we know that there's demand. So let's start with Tesla, and we will use Toyota as a reference. So Toyota is the best-selling car brand in the world. They sell about 10 million cars a year, and that accounts for almost 10% of the cars sold in a year around the world. About 90 million cars are sold in a year new. Toyota share of that 90 million is 10 million. So actually that accounts for more than 10%. That being said, let's say in the future that Toyota does not create a strong electric car brand and Tesla becomes the next 10% market share owner of worldwide car production and sales. In that case, best case scenario for, let's say, 10 years, 20 years, maybe even, let's say, 30 years from now, Tesla could potentially reach a point of producing the volume that Toyota produces. 10 million cars a year. Right now, they're near a million cars a year. With more factories opening up in 30 years, Tesla could get factories ramping out 10 million cars, I'd say, a year, and selling them each year. And obviously, I'm not going to say that the third world countries are going to get out and become kind of like the first world countries, because, in my lifetime, it might not happen. Say some of them do. Let's just go with the 10 million. So the market of car companies around the world combined is 90 million cars, right? 90 million times the average or median price of new cars, which, check these numbers, I'm actually making them up, but I'm giving an educated guess just so that I can go fast through the video. 35,000 per new car. This is gonna equal, I'm not gonna really calculate, I calculated before, let's see if I remember. It was something like $2.5 trillion, and that's revenue. So just to get the best case scenario evaluation for Tesla, let me put the ticker symbol for Tesla. All we gotta do is say that Tesla is now 10% of all car sales, and we got ourselves the best scenario evaluation. So 10% of 2.5 trillion is simply 250 billion. So Tesla's market cap in the next 30 years, 10 years, or people already pricing in the possibility of Tesla reaching 10% and 250 billion revenue, which is doable. I think Tesla might be able to do it. But Teslas are higher priced, so we can either go by this. Right now, Tesla's actually evaluated based on Robinhood, Yahoo Finance. On the trading is about, I think, 600 billion, so way above this mark right here. But remember, people also take into account other markets that Tesla is in, like SpaceX, SolarCity, and Neuralink, and the Boring Company. So all those also can affect the underlying value that you calculate yourself. So you can go based on this, or the 10%, which is like 11 million cars times 35K. But Tesla cars are pretty highly priced, so we could say the 45K, and the 45K times 10 million is gonna equal 450 and then you just gotta add. So 450 billion could be the way you calculate it as well. So there's two ways. One is 10% of 250 trillion, or 10% of cars, which is 10 million times Tesla's average or median price of a car, which is like $45,000, and that's gonna give us this, or with this. So something that's around this is probably more believable, or still below what it's currently at, meaning Tesla could keep dropping. Tesla was, I think, almost at a high of 1,000 at current shares. But next thing what we want to do is calculate the price per share. And what was I going with that? Yeah, so this is how I would calculate stuff. Obviously this is not the final, because you got SpaceX, the Boring Company, Neuralink, and the Solar City, solar whatever stuff they got. So from all this you could get a range of prices, and all we gotta do is divide the 450 billion by outstanding shares, and that should give you the price per share. And that's maybe a price target that you have, or that I would have, not you, because you could do your own calculation based on however you want. So that's basically how I would do it. It comes close to what it currently is. It's more realistic. And the outstanding shares, for example, I would do this. It would just be, I think Tesla has close to 1 billion. Not exactly 1 billion, but like 950 million shares. Divide that by 450, it's gonna leave you at close to like $500 per share. So Tesla, in my opinion, if it doesn't take into account SpaceX and all that stuff, and Tesla gets 10 million cars a year and doesn't do the automated taxi, $500 a share is reasonable. Right now we're at 700, around there. So if it drops another 200, 500, for me, in my opinion, would be a decent price and a realistic one that could be reached in 30 years. But if you do the math and do the valuation of the space industry, the boring industry, the solar panel industry, the Neuralink industry, do all that, get Tesla's or Tesla Inc.'s share of that, and add it to the valuation and divide by the outstanding shares, and then you get a new price. Maybe you get 1,000 per share after you do all that. But the SpaceX industry, probably not that big. There's only a few customers. Yeah, it's expensive stuff to fly up there, but not a lot of satellites being flown up there. And in my opinion, I think I could be wrong. The Boring Company, not a lot of boring holes probably being bored. Who knows? But that's the basic idea. We're just getting a rough estimate of the evaluation and dividing my outstanding shares to get the final price. So one thing I really want to make clear is that all I'm saying is that evaluation basically equals revenue. That's all it is for me. I seen it for Toyota. Their yearly revenue is basically their current evaluation, and they're already a very well established company, owning 10% of the market share of cars. In this case, the evaluation, the 500 billion or 400 billion, whatever evaluation we gave Tesla, it's in direct correlation, basically equals revenue. So what we want to do is basically straightforward. What is the best potential revenue this company could reach when it is fully mature? And that's the best case scenario. Whenever I look at a company, what is the best case scenario in terms of revenue for this company when it's finally fully established? That will be my market cap. And with that market cap, I just divide the outstanding shares, and that's my price target. That's my price for investing for me, and in my opinion, shouldn't be for you. This could also be very affected depending on margins, how profitable it is. The car industry, look at Toyota, how profitable is it? And then you can make in relation to that, how this other industry would be evaluated. For example, if Toyota's margins are 10%, profitability and they're making 250 billion revenue, and they're 250 billion market cap, and you got like computer chips, they have a profit margin of, I don't know, let's say 30%, I could be wrong, then I would probably be like, hey, that's 3 times more than Toyota. Meaning I will, calculate the revenue of that chip company at its best case scenarios, and then multiply that times 3, and that would be in my opinion, what I would evaluate it, and then divide by outstanding shares, and simply get the price per share in that way. So I hope this video was helpful. I know it was long, but I think it would be helpful to just share I just wanted to share my ideas, and I could be wrong. Don't go based on my opinion. Let me know if you think this is a weird way to calculate it, but I'm just trying to be as straightforward and as mathematical as possible, just straight to the point, revenues, profit margins, and all that stuff. I didn't give you real numbers, so all those real numbers you gotta look up yourself. These are all like entertainment numbers. But if I were to do a calculation for like a stock that I like, I would do this. You shouldn't. You should do your own research. If you like it, do it at your own risk. But I'm not a financial advisor. I'm not liable for your investments. See you on the next video. Bye-bye.